Welcome all to the mid-year mark. The good news for many investors is that 2024 has so far been a story of relatively solid economic fundamentals. Some equity markets are charting new highs at regular intervals. For example, the S&P 500 has hit more than 30 all-time highs in 2024 alone. Underneath the surface, there has also been a rotation from mega-cap and high-growth stocks to small medium-cap and core and value stocks. There are signs the economy and inflation are slowing, proving that central banks' tightening measures have started to take effect. Markets are now pricing in more than 2 rate cuts this year. This backdrop has shaped Fidelity's thinking around 3 themes for Q3. First, equities are still attractive, led by earnings growth and in some areas undemanding valuations. The second is controlled stabilization in China, supported by targeted policy measures. Finally, we are thinking tactically as the divergence between sectors and geographies is expected to be high. We are also mindful that political risks remain a threat, as evidenced by recent developments in Europe. Regional investors in Asia have entered the new quarter with a spring in their steps. Many are now expecting rate cuts to commence in September, and calls to put cash to work ahead of these cuts have grown. An overweight view to equities remain the majority for our clients. While US, Japan and tech are still preferred, the investor gaze towards China is rising. This bodes well for broader Asia, where we are starting to see invigorated confidence in the region. In fixed income, quality investment-grade bonds remain the consensus trade as investors look to lock in yields and capital appreciation potential. The hunt for income has not cooled. Investors have leaned into the higher quality parts of US investment-grade markets, like treasuries, to catch the turn in interest rates. Decent fundamentals and China's outlook for controlled stabilization means we are adding equity risk to our portfolios. But doing so requires some nuance. The concentration of the US equity market has hit historic highs, with the largest index stocks determining the direction of intraday returns. In the past, a steep rise in market concentration has always reversed. Now, this enforces Fidelity's long-held view that investors should consider diversifying portfolios beyond areas that have done well over the past several quarters. Mid-cap stocks currently offer long-term growth potential at a reasonable price, and they should prove resilient to higher rates. Investors can also consider equity income, which tends to be less risky. Dividend yields may become more attractive as interest rates fall. The payout per share can rise over time as corporate earnings grow. Income also typically makes up over 60% of its long-term returns, which can help to cushion total returns if markets take a turn. We like companies that operate in defensive sectors like consumer staples and pharmaceuticals that can consistently grow their dividends across cycles. Investors seeking an even higher level of income can consider dividend strategies that actively write call options on stocks. For investors seeking to capitalize on structural and cyclical growth trends in Asia, dividend stocks in the region serve as a more defensive option.